Welcome to This Week in Impact, where ImpactAlpha editor David Bank and I break down some of the most interesting impact investing stories of the week. I'm Brian Walsh. It's Thursday, June 6th. David is on assignment this week, so today we have a special guest, the always insightful Jessica Pothering, ImpactAlpha's senior editor of Deal Flow and Emerging Markets. We'll discuss this month's list of impact funds actively raising capital, how Africa's funding drought has claimed several once high-flying startups, plus
we're able to sell literally meals that are prepared today by incredible chefs for $6 or $7.
How a social enterprise is providing healthy food to California's food deserts and uplifting communities. That's all coming up on This Week in Impact. Hi, Jessica. Great to have you back on the podcast.
Hi, Brian. It's great to be back. Thanks.
Now, you recently moved to Lisbon from Amsterdam. How has that transition been?
It's been great. We have like 300 days of sunshine here, which is basically the opposite of the weather in Amsterdam, so I can't complain.
As charming as Amsterdam is, I can imagine 300 days of sunshine is a great appeal.
Yeah, I feel I feel like I didn't give Amsterdam proper credit. I loved living in Amsterdam, and it's a great city, but boy, does it rain a lot.
Speaking of rays of sunshine, one of your responsibilities is to publish ImpactAlpha's monthly list of impact fund managers who are actively raising capital. What is it you're looking to accomplish with this editorial product?
I think we started the list, I would guess, about 18 months ago at this point, and we worked on it at first in partnership with Realize Impact. It was an idea they brought to us, but actually simultaneously we've been hearing from our readers that they loved reading about deal news that we were publishing in the newsletter every day, and seeing what was getting funded, seeing what funds were coming to market, which ones were closing. But their one complaint was that they were finding out about all of these investment opportunities after they had closed. And so then the idea came to, as we were hearing in the market about new funds that were coming out and we're looking for investors, that it would just be interesting to profile some of the new investment theses that were coming to the market. So that's how the list started.
So making the news actionable instead of just making people feel like they were being left out of closed deals.
Yeah, and I mean, I should say that obviously we write about these because we find them interesting, and it's interesting for us to see how trends are evolving around what fund managers are thinking about and where they're spotting needs in the market. But of course, I mean, these are short profiles that we put together from a journalistic standpoint. We're not obviously advocating for anybody to invest in any one or particular thing.
I guess we should also note our standard disclaimer: the list is based on information sourced by ImpactAlpha that has not been further reviewed by the fund managers nor verified by third parties, so it's not guaranteed for accuracy or completeness and should not be relied upon as investment advice or recommendations. And nothing about the list constitutes, as they say, an offer to sell or the solicitation of an offer to buy securities. How's that for legalese?
Yep, that's I think you said it better than I would.
Now, can you take us behind the scenes of the list? How do you source the funds that you highlight?
It's a bit of a mix. I sort of funnel our deal news every day, and so I'm often catching news about new funds that are in the market, and so sometimes I'll reach out to them and request more information. But then also we have an intake form where anybody who's aware of a fund that an impact fund that's in the market can submit. So you don't have to be affiliated with the fund. You don't have to be working with that or an investor. Just if you're aware of something in the market that we should be aware of, we have an intake form that you can fill out. So it comes from both ways.
And I note that intake form is on our website, and we'll also put a link to it in the show notes for folks to check out. And I noticed that this month you featured nearly all private debt funds. So why would you say that credit is more interesting to investors than equity right now?
That's a good question. I don't know that I would say credit is more interesting to investors. It just sort of happened that we saw a little boom of debt funds coming through, and it made for an interesting trend. I mean, of course, in the current interest rate environment, I think returns on debt seem to be more attractive to investors than on the equity side. But frankly, more often than not, the funds that we get coming through the list are equity funds. So it was interesting to see more debt funds cropping up.
So can you tell us about some of the funds that you highlighted this month?
Yeah, what was interesting about them is these are not sort of your typical like project finance funds or in another side like microfinance debt kind of things. These are all really niche strategies. They're using a lot of blended finance and catalytic capital in order to sort of seed new markets. And so they're very niche. One of the ones that I thought was most interesting is an organization called New Story Ventures, and what they're doing is they're acquiring land in Mexico, and they're basically doing development so that utilities are ready to come in, sewer lines are being laid, and then selling those plots of land to what would be first-time homebuyers in Mexico. And most of the people that they're targeting are sort of on the lower income range, and it's giving families who would otherwise have a really hard time qualifying for like land acquisition financing or for mortgage financing a pathway to home ownership and a step up on the equity ladder.
That sounds interesting. What about another fund?
Yeah, and another one that I thought was really cool was it's a partnership between FiberShed and the Sustainable Agriculture and Food Systems Funders. So there's two organizations that have developed this Fibers Fund. And what they're trying to do is counteract some of the negative environmental and social impacts of the textile industry by propping up a new crop of entrepreneurs and small businesses that are more involved in regenerative and natural fiber development. So when you think about negative impact, you think, a lot of fast fashion ends up in landfills, synthetic materials are made from unsustainable, often fossil fuel derived materials. And then also there's often a social impact in textile work, whether that's in the quality of the jobs or just where a lot of the production facilities, these heavy industrial facilities are located. Often that's around lower income communities or more marginalized communities. And so Fibers Fund, they're providing not just debt, they're also providing, catalytic grants and more flexible financing structures to help like hemp growers, for example, support their farming operations and their fiber production. And then they also have a special dedicated facility for Black founders of fiber companies, because they recognize that the path to a more sustainable textile industry should be just and equitable.
All right, that sounds very compelling, and people can check out these funds and others on ImpactAlpha.com. And you, Jessica, publish this list every month, right? When does the list usually come out?
It's the first Tuesday of every month.
All right, well, we'll look for those moving forward. Let's take a quick break. When we come back, how promising startups in Africa have been impacted by the lack of capital to scale their businesses.
I'm Eric Carmen Gonzalez, ImpactAlpha's Director of Subscription Growth. Ever feel like there's so much happening it's hard to keep up? We hear you. That's why we created ImpactAlpha Latin America, a monthly newsletter for impact investors who want to keep their eye on trends and investments happening in Latin America and the Caribbean. Follow the money and connect with agents of impact powering Latin America's impact economy. Visit our Instagram page @ImpactAlpha and click on the link in our bio to sign up.
Now, Jessica, your coverage focuses on emerging markets, and you've recently reported on a series of disappointments, particularly in Africa, with once promising companies stalling or shutting down. What is driving this?
Well, I think the obvious answer that I hear from pretty much everybody is there's a funding drought. Startup funding in Africa has fallen off of an absolute cliff in the last 2 years from the height of the market, which was in 2021.
Yeah, and you reported that startups on the continent raised just $542 million in the first quarter of this year, of 2024. That's down from $2.3 billion that they took in the same quarter in 2022. So that's, one fourth of the amount of capital is coming into the continent at that point.
That's right. Yeah, it's been, like I said, fallen off a cliff.
So can you give us an example of how this is impacting some businesses?
Yeah, I mean, the latest example of that is this company in Kenya called Copia, and they started in 2013 with this vision of being like the rural Amazon.com for Kenya. And their thinking behind that was in rural areas, often farming communities. So, there's just not a lot of great infrastructure that goes into those areas in many places. And so if you're living there, you just don't have access to the same kind of comfort goods that you would if you lived in a big urban center like Nairobi. And so what they did is they assembled effectively like a Sears catalog, basically, of a whole range of products. They had a network of rural agents, and households could go to these agents, look through the catalog, place orders, and then the agents would handle. They would hand over those goods as they were delivered through the Copia network. And so, and they've been doing this. They started in Kenya. They expanded at one point into Uganda. And then last year, as the funding dried up, they really hit that wall because at this point, it's a fairly capital intensive. It's a very physical business model, and that makes it quite capital intensive, and the growth funding just wasn't there. And so they went through a couple of rounds of layoffs, raised some emergency funding in December, but it wasn't enough. And we just found out in the last week or so that they had gone into receivership. And so they'll be trying to work out how to keep the Kenya business lines afloat, albeit in a more scaled down fashion at this point, and until they see if they can raise some more money to keep going.
So in this with Copia, you reported that it was started in 2013, and this type of business needs a little bit longer than it was given essentially to succeed. So what's the this is where the patient capital comes in, is backers that are willing to be in there for the long term, and I do think that there are a number of investors in Copia that are impact investors, that are patient investors. You had some development finance institutions like the U.S. Development Finance Corp and Germany's DEG and Sorensen Impact Foundation, LGT Group, Goodwell. So it's not that the investors weren't patient, it's just that the follow-on investment capital just wasn't there.
Right. I spoke to the team at Goodwell Investments who worked on the Copia deal, and they actually, they were also an investor in another sort of parcel delivery and logistics organization in Kenya called Sendi, which ended up folding earlier this year. And what they said was, these are fairly unproven business models, and they take a long time. And especially because the focus is on lower income customers who are quite price sensitive. In order to make these models work, they really need to be operating at scale. And in order to do that, it just takes a lot of money and a lot of time to get there. But they really did feel like there was a path to profitability for Copia and some other similar models that they've seen. It's just that the type of growth funding that was available in the market was, scarce at the current time, but also just didn't have the patient timeline that would have allowed them to get to profitability in a couple of years.
So can you give us another example of another logistics startup that has faltered in recent times?
Yeah, there have been a few. I think logistics is especially hard hit by this because there's a lot that you can do with tech enablement and logistics, but ultimately you still have to move things from point A to B, right? And that tends to be operationally quite heavy. Another one was iProcure, and they were also based in Kenya and working on agri-product distribution. So they had a network of rural agents that was selling and distributing seeds, fertilizers, other farm inputs to Kenya's farmers. And they similarly hit the same sort of funding wall that Copia and others have. And it was also announced a couple weeks ago that they were also going into administration.
So obviously the investors are, out from their initial investments, and the companies, shutting down will have to lay off employees, but there's also a real impact on the customers that were relying on these products and services.
Yeah, I think that's really, from an impact investing standpoint is really the sad part of the story is, take, for example, Copia has been running these delivery lines in rural Kenya for a decade. And so there are thousands of customers who have gotten used to that service, who are used to working with these agents. They were providing income for these, this agent network. So there's really a ripple effect and livelihoods improvement through these types of businesses. And, now what's been operating for 10 years is, suddenly either not going to be there or will be there in a substantially scaled down version. The hope, of course, is that the Copia team will be able to come out of this on the other side and keep their Kenya business not only going, but growing at some point. But yeah, in the meantime, really the loss here is what is the impact on these consumers that the impact investing community is incentivized to support and is hoping to impact. So so that's really the sad part of the story.
Well, from the highs to the low, the good and the bad, the booms and the busts, ImpactAlpha will continue to cover emerging markets and these companies and the people served by them. And hopefully we'll have more promising news to report in the future. But let's take a quick break. When we come back, we'll go to LA, where we'll hear from a founder who's trying to bring healthy fast food alternatives to underserved neighborhoods.
Every day, ImpactAlpha uncovers stories that make a difference to impact investors. I am Zlaim Abibo, Chief Operating Officer at ImpactAlpha, here with a special reminder. Subscribers get the award-winning brief 5 days a week and so much more. Unlock exclusive coverage, get access to subscriber-only calls and Slack channels, plus search hundreds of jobs and internships at the ImpactAlpha Career Hub. What are you waiting for? Subscribe today. Learn more at impactalpha.com/subscribe.
Finally today, in 2013, after a brief career in finance, Sam Polk returned to his native LA and decided to help parents in underserved neighborhoods get their families healthy. That idea eventually led to Everytable. ImpactAlpha caught up with Polk and an Everytable franchise owner to learn how it all works.
My name is Sam Polk, and I'm the founder and CEO of Everytable. Everytable basically is providing healthy, fresh, scratch-made meals for less than the price of fast food. And we exist to solve this problem of food deserts and food inequality. Everytable basically decided to solve that problem by creating a new model of cooking and selling food where we centralize our cooking into a single kitchen. So we get ingredients directly from farms and have some incredible chefs turn those into healthy, delicious, scratch-prepared meals. And then we take those meals to our now 38 locations around the city. And because we centralize the cooking, we can be incredibly efficient in that process. We're able to sell literally meals that are prepared today by incredible chefs for $6 or $7 in some communities, and then about 8 or 9 in other communities, which is what we call a variable pricing model, which basically makes sure that we're profitable in every location, but also that we price such that each neighborhood can afford those meals. Like many restaurant or retail companies, we started to look at franchising as a great capital efficient way to expand. Our belief is that it does take a special person to really be a successful entrepreneur, but that special kind of person can, look like a lot of different kinds of people and come from a lot of different kinds of neighborhoods.
My name is Susana Cabrera, and I am a franchise owner. I was a street vendor. I was selling hot dogs in the street, but I also had an interest for a healthy living.
Everytable is in the process of basically converting all of our 38 stores into franchises, and that's through multi-unit franchise ownership. When Susanna, for example, started, our program was really sort of built around single unit ownership, but we've now realized the power that can come from operating multiple locations at a time.
And then we have that amazing opportunity of becoming owners. And that's when I decided, like, hey, I do want to own my own business. I do see myself owning a business like Everytable because I'm really proud and happy the fact that we offer nutritious fast food.
We've raised about $14 million so far, and now we've built out our plan for the next 5 years, and we basically need around $25 million in additional capital to take us from where we are to hundreds of locations, and all of those, again, would be owned by, it's sort of like a double whammy for impact investors because you get, bringing healthy food access at affordable prices into communities, and then you also get to support economic empowerment from entrepreneurs who otherwise wouldn't have the capital to really change their own lives and their families' lives from a wealth creation basis dramatically.
I want to create a chain of supporting other women so they could own their own business if they wish to. Or in another way, I want to give back, and I want to find a way of, like, how do I give back this blessing? Because it was a blessing. And I feel that responsibility. Their community needs more business owners.
We've been able to raise capital from, a wide spectrum of investors that, goes from one end of the spectrum, just pure venture capital, to the other end of the spectrum, pure foundations, and everything in between. That could be family offices or impact investors or CDFIs, et cetera. And that has proved a great benefit to us. And at the same time, because the venture capital growth markets shut down, we had to adjust our strategy and get, tighter and more profitable more quickly, for sure. The way we capitalized our social equity franchise fund was really, in my view, a symphony of the impact investing space. And what I mean is that we pulled together equity capital in the form of program-related investments and grants. And these were from, really forward-thinking foundations like the Kellogg Foundation and Kroger Foundation and Annenberg and Dignity Health and California Wellness. And so if you think about all of that together, it's really all of this capital and municipal programs and big foundations coming together to say, the racial wealth gap is real, and a lot of it comes from historical lack of opportunity. So what if we can just turn the scales a little bit, not so that Susanna has to work like the Dickens to make it work, but she's going to have some capital that she might otherwise have had if not for the history of this country. And so in a really wonderful way, I'm really impressed and grateful to the entire impact investing space for the strides that community has come forward with to really make a difference in, food systems in California so far, and also truly to enable people to build serious wealth they wouldn't have otherwise had the shot for.
A person that's been in the money world knows how to move money around and knows that money is going to work for money. But when you, like people from my background, the scare number one is the money. And if they had a little more faith and believe that they could do the hard thing, they will be tapping into those resources. And I definitely feel that we can do it. We could create something, especially women of color, right? That for some reason we just don't strike hard. And I think if the more we do it, the more we learn how to navigate the business world.
Everytable's social equity franchise program continues to look for entrepreneurs from under-resourced backgrounds who are short on capital but long on talent. All right, well, that's going to do it for this episode of This Week at Impact. Thank you so much, Jessica, for stepping in for David Bank this week.
Thanks a lot, Brian. It was fun.
And thank you all for listening. If you liked what you heard, please subscribe to the podcast wherever you listen and share this with a friend or colleague. If you want to help us out, be sure to rate us and give us a review on Apple Podcasts. It really helps other people find the show. If you have any feedback for us, please send us an email to podcast@impactalpha.com. We love hearing from you. This Week in Impact is a production of Impact Alpha and part of the Impact Alpha podcast network. For more exclusive stories about the world of impact investing and sustainable finance, join other agents of impact by subscribing to Impact Alpha. Just go to impactalpha.com/subscribe for full access. Thanks, as always, to our producer extraordinaire, Isaac Silk. For Jessica Pothering, in for David Bank, I'm Brian Walsh, and we'll see you next week for more Impact.